Ever considered which funds have the best risk-adjusted returns for a good price? Then let's look into ETFs such as FXIAX, VOO, and QQQ. The highlight of discussion today is FXIAX, a widely recognized exchange-traded fund with its unique attributes and performance metrics. The Fidelity 500 Index, or in the backtest FXAIX, started its journey with an initial balance of $10,000, carving out a unique space in the investment world. Over the years, FXIAX has experienced its own share of market fluctuations, standing up to the test of time. Now let's contrast FXIAX with other popular ETFs, the Vanguard S&P 500 ETF or VOO, and the Invesco QQQ Trust QQQ. These funds each representing different market segments and offering varying opportunities, so remember to subscribe so I can continue to make videos deep diving interesting funds for investors. Many funds have their share of highs and lows. By the end of the analyzed period of 12 years, QQQ had significantly outperformed both FXIAX and VOO, with a considerable increase in the initial investment. Yet does this conclude that FXIAX isn't a worthy? That's the intriguing question, isn't it? Let's delve deeper to uncover the true worth of FXIAX. One of the key metrics to consider when comparing investments is the compound annual growth rate, also known as KAGR. This gives us a snapshot of the average annual growth rate over a specific period. If we take a look at our three funds, FXIAX, VOO, and QQQ, it's clear that FXIAX holds its own with a CAGR of 13.98%, though QQQ takes the lead with a CAGR of 19.19%, and VOO comes in close with 13.95%. FXIAX's consistent growth paints a promising picture. But there's more to consider than just growth rates. We must also look at the potential risks. That's the standard deviation comes in. This metric provides us an insight into how much the returns of an investment can deviate from its average, effectively measuring its volatility. Interestingly, FXIAX and VOO both have a standard deviation of 14.36%, which is significantly lower than QQQ's 17.54%. This suggests that FXIAX shows lesser fluctuations in returns. When we examine the best and worst years for each of these funds, FXIAX shows more stable fluctuations with returns ranging from 32.37% to negative 18.19%. QQQ, despite having the highest returns, also had the worst year with a loss of 32.58%. Focusing on the maximum drawdown, FXIAX and VOO exhibit smaller of 23.88% and 23.91% respectively, compared to QQQ's larger drop of 32.58%. While QQQ might offer higher returns, FXIAX offers a more stable growth rate with less volatility. Ultimately, investors need to balance the allure of high returns with the reality of potential risks and market volatility. Risk-adjusted returns is not merely about the raw returns, but also about the amount of risk you absorb for those returns. Let's delve further into the notion of risk-adjusted returns. Imagine you're balancing on a tightrope, with the potential for high returns on one side and the risk of major losses on the other. This is the stage where Sharpe and Sortino ratios become important. They measure an investment's performance against a risk-free accounting for its risk. The higher the ratio, the more optimal the investment's risk-adjusted performance. In our comparison, we focus on FXIAX, which demonstrates a Sharpe ratio of 0.91. Although it is slightly lower than QQQ's 1.03, it still illustrates that FXIAX provides solid, risk-adjusted returns when compared with QQQ and VOO. Additionally, FXIAX posts a Sortino ratio, another risk-adjusted return measure specifically for downside risk, that's nearly comparable. Even though QQQ stands out with a ratio of 1.74, FXIAX is not far behind. So, while QQQ may provide generally superior risk-adjusted returns, FXIAX holds its own, particularly when you consider expenses. Remember, the bigger picture isn't just about the highest return, but about the best return for the level of risk you're willing to take. In the investment universe, one should pay close attention to costs, especially the expense ratio. This annual fee, charged by all funds or ETFs to their shareholders, can significantly impact your returns over time. This fee encompasses a variety of fund expenses including 12b-1 fees, management fees, operating costs, and other asset-based costs. Let's dive deeper into FXIAX, the Fidelity 500 Index, and its expense ratio. FXIAX boasts a low expense ratio of just 0.015%, which is half the cost of some other ETFs. To put this into perspective, let's take a look at VOO, the Vanguard S&P 500 ETF. VOO carries an expense ratio of 0.03%, twice as FXIAX. While these figures may seem tiny, they can make a significant difference in the long run. The lower the expense ratio, as with FXIAX, the less you lose to fees, resulting in more of your money staying invested. Hence, FXIAX could, in the long run, offer investors considerable savings thanks to its lower expense ratio. So, which ETF should you be eyeing? That's the query that's worth a fortune, isn't it? Analyze the performances of QQQ, VOO, and FXIAX, all distinct in their own right. With great returns, QQQ shines but comes tethered with higher volatility, a gamble that could yield high dividends or substantial shifts. VOO, on the contrary, offers a balanced approach with average returns and moderate risk profile, a steadier course for those not seeking too many waves. However, what truly catches the eye and merits a more in-depth discussion is FXIAX. With similar returns and risk metrics as VOO, it differs in its lower expense ratios. This gives FXIAX an edge as it could potentially save investors significant amounts over an extended period. Plus, when you look into the difference of returns, both VOO and FXAI would mean that you would have come out on top with an extra 0.015% in savings every year, in comparison with investing in VOO. It reinforces the notion that every penny saved is a penny earned. If you're comparing the high returns of QQQ, the balanced approach of VOO, and the cost-effectiveness of FXIAX, your focus should lean towards the latter. But remember, always conduct your own research before investing and consult financial professionals.